This is Viewpoints by Hennessy, a podcast featuring the latest thinking from the team at Hennessy Funds. My name is Jay Coulter, and joining me for this update is Ben Cook, who is the portfolio manager of the Hennessy Energy Transition Fund and the Hennessy Midstream Fund. Let's jump right in. Listen, Ben, we have a new administration coming in here in the United States. What do you think the impact will be for the energy markets?
Yeah, great question, Jay. We anticipate, in contrast to the Biden administration, we expect the Trump administration to have a more favorable view of traditional hydrocarbon energy markets. We expect to see a loosening of restrictive regulations and an easing of permitting impediments on federal lands. Of course, we'll see the pause on LNG export facility approvals lifted in short order. Essentially, again, a number of measures to help support growth in the hydrocarbon energy industry. In terms of renewables, we expect the Trump administration to revisit the Inflation Reduction Act, and will likely see a review and repeal of some subsidies that favor uneconomic technologies. Although we would say that the Trump administration likely will be more agnostic towards renewables as opposed to anti-renewables, as many of the current renewable projects in operation and under development reside in red states. But the bottom line here, Jay, is we think the Trump administration sees the United States energy abundance that we enjoy here as a source of strength, and we think the administration will work to unlock those resources to make those available to our trade partners, ultimately presenting challenges to our geopolitical rivals. But in that environment, we expect growth.
So, Ben, how do environmental regulations and policies influence your investment decisions within the energy sector?
Yeah, generally speaking, as part of our repeatable investment process, we seek to minimize all forms of risk, including regulatory risk. Companies operating in politically unfriendly areas to the energy industry could be included in our portfolio, but they would have to be valued fairly to account for potential business disruption risk in the event of policy change. And in the case where policy risk is too difficult to underwrite or estimate, we would simply dismiss those exposures from the portfolio altogether to avoid unnecessary risks.
So, Ben, in our last interview, we discussed how AI is driving energy demand. How have the supply and demand dynamics evolved in the last 6 months?
Yeah, the conversation around artificial intelligence continues to be a dominant narrative in the marketplace. Our view of U.S. electric demand has improved slightly since the last time we discussed this issue. We now see demand growth on the order of 2 to 3% per year through the end of the decade versus our prior view of 1.5 to 2%. Of course, this is based on what we're hearing from both utilities and power generators in that sector. And this is all being driven by data center demand for electricity, where power demand growth is expected to grow 10 to 15% per year through the end of the decade. And as we mentioned previously, the demand for energy to fuel the grid as it exists today will come from the energy resources that power that grid, and that's predominantly coal and natural gas and renewables and nuclear. But we see natural gas as a relative winner until other forms of energy like nuclear and solar can scale to meet projected demand.
Ben, do we even have capacity to meet this expected demand?
The short answer is we do. The longer term answer is a question of the power generation sector rising to meet demands. And we think that can happen. We're seeing hyperscalers such as Amazon, Meta, Microsoft, et cetera. They're pursuing power supply deals with power generation companies and utilities. We're seeing headlines of nuclear plant extensions and also the potential for restarts of mothballed nuclear facilities. In our view, an all of the above solution will have to be in place to meet industry demands, but we do think it's possible for the power sector to meet growing demands for electricity going forward.
So, Ben, as portfolio manager of the Energy Transition Fund, what are your thoughts around the renewable energy space today?
Yeah, we view the sector favorably given the demand tailwinds for power that we see as being very visible. But policy uncertainty does remain, and valuations where they are today remain elevated, and that's kept us on the sidelines as it relates to exposures to renewable energy companies. I would say at the current time, our exposure in the Energy Transition Fund is minimal.
And what's the case for natural gas today?
Yeah, obviously, a key tailwind to demand growth for natural gas is the need for power and the fuel necessary to generate that power for artificial intelligence. But even before we started talking about the projected demand increase associated with AI, the natural gas story was very strong. Growing LNG exports, the electrification trend that we're seeing across a number of industries in the U.S., as well as the onshoring of industrial activities here in the U.S. Those are all combining to make for a very strong demand picture going forward. And if you consider the fact that the incoming administration has a favorable view of hydrocarbons, we expect that we'll see the natural gas market grow significantly, both here in the United States as well as abroad.
So, Exxon is the largest holding in the Energy Transition Fund. What is the investment case today?
Yeah, Exxon has been one of our largest positions for some time, and the company continues to generate relatively strong operating and financial results. They've had a great deal of success through both the drill bit and through M&A in their upstream businesses, been able to grow their volumes nicely. They've also had a very strong focus on cost reduction, which has enabled them to deliver a very strong margins as well, and that's translated to good cash return to investors. The company stands alone in terms of its ability to generate shareholder return, both buying back stock, increasing dividends, and reducing debt on the balance sheet. The management team has been very adept at navigating the energy transition, and we expect that to continue. And so we like the positioning in Exxon today.
You're also the portfolio manager of the Hennessy Midstream Fund. What are the current investment opportunities in the midstream segment of the energy sector?
Yeah, midstream sector fundamentals are strong today, Jay. A number of basins are growing here in the United States. The Permian Basin, probably the strongest grower. We're seeing volume growth in crude oil, natural gas, and natural gas liquids. And that basin will require infrastructure, both in basin for gathering and exiting the basin for transportation. So we see growth opportunities there. U.S. energy exports, as we've mentioned, have remained relatively strong. We're seeing rising volumes of natural gas. We're seeing rising volumes of natural gas liquid exports to the global petrochemical industry. And of course, the geopolitical risks that continue to simmer around the world underscore the importance of the United States as a trade partner. We think that'll continue to bode well for the U.S. Export volumes of hydrocarbons. Companies that operate integrated value chains connecting the end user to sources of supply, those companies have been demonstrating very strong financial results. We think those companies are very attractive. And I would tell you the alignment between corporate managers and investors has never been better. We're seeing a capital allocation program across the industry that not only allows the industry to grow modestly, but also deliver shareholder return in the form of, again, just like Exxon, share repurchases, debt reduction, and of course, a payout of dividends and distributions. So we like the midstream sector right now.
Energy Transfer is the largest holding in the portfolio. Ben, what is the investment case for that company today?
Yeah, Energy Transfer is one of the largest positions. We like that company's asset base quite a bit. They have an integrated midstream network of assets linking some of the most attractive shale basins here in the lower 48 to end user markets and points of export along the Gulf Coast. That asset base, we do see growth opportunities and the opportunity to participate in growth in power generation demand, delivering natural gas to power generation facilities throughout the U.S. We'll see volume expansion of exports, both natural gas liquids, and we see them benefiting from that trend, as well as the expansion in LNG exports, which indirectly will support their operating results. Ultimately, balance sheet improvement and again, cash return to investors is very attractive at Energy Transfer and again, continues to be a favorite name in the portfolio.
Excellent. Ben, thank you so much for your time. Viewers, to learn more about Hennessy Funds, please visit hennessyfunds.com.